and give money to the IRS, but it's really your choice. And so we're really asking people to look at it from that standpoint. This one again has a $5 million 10% component up front. The second $20 million is going to be a pledge pay over 10 years. So you can see that half of the gift comes in with cash and in a 10-year period. The third component, this is a $21 million payout from a lead trust. So unlike the asset that you gave away, this is someone who says, I won't give away the asset, but I'll give you income. So this is the golden eggs. Somebody owns a building, somebody owns a business, somebody has some sort of partnership that is providing income. And the reason you do it, and I cannot tell you how important it is to look at these now, 2010, 2011, is that interest rates at their lowest make lead trusts an ideal opportunity. So what a person would do is, this lead trust is a $15 million property. It pays the charity 7% for 20 years for a total of $21 million. And the final component, we have a $4 million, when I die, I'll give you something. Life insurance, IRAs. IRAs are a beautiful gift to give to a charity. They are highly taxed. And so what I did was I took this one step further than what I did with the executive committee. I looked at the two in that piece of the pie that had the trust. The $1 million charitable remainder trust, what's the impact to an individual? You know, what's in it for you personally if you were to do these kind of gifts when we're planning with our donors? The tax deduction is $368,240. The annual income to the donor to supplement retirement is $60,000 a year. And the cumulative income to donor is $1.3 million. So you're thinking it doesn't add up? This is a charitable remainder unit trust, which means rising value, you're going to get additional income. So you might start at 60 and you get increasing income. So you're getting your own raises for inflation in retirement. The sample $15 million lead trust, that was the second pie chart. That one basically says the gift tax deduction is $15 million, and this is a really conservative scenario. We all know that 2010 is the magic year where no one has estate taxes. How long do we think that's going to last? Most likely not, and we're all shocked on April 22nd that we still have no estate tax. So the value of family is assuming that there was no appreciation in the property that you hold. Now, most people are looking at their assets to the next generation, and you know that you're going to have estate tax issues. So this is an ideal way to move money to the next generation. And the cumulative income to charity is the $21 million. So that just kind of further describes those two gifts. And so the last slide is really what are the opportunities and why is 2010 so important? The traditional IRA to Roth is something that y'all probably heard about or read about. And people are saying on the streets, and you may have already heard it, don't convert your IRA to a Roth. Who would want to pay? That's the government's way of getting a bunch of taxes. When in fact it isn't. Sure, if people did convert, there would be taxable income that could go to the IRS. But if you were really strategic and you were really smart and you've all thought about, you know, when we look at our donors for making that transformational gift, how do you get that done? You get it done in 2010 because you can roll an IRA to a Roth. You can take the tax hit over 2 years. If you can't use all of that, you know, when you look at the tax effect, people will do zero tax planning and go backward. How do I wash away the tax? You could make a gift of this size. Your attorneys and CPAs and financial advisors work backward from the magic number of converting the IRA to the Roth. And then you get the 2 years of taxable income, so you can split it so you're not in a huge bracket on the rollover. So I'm here only because of the critical timeline, and this is a very unusual tax year. So for the people you know, when they say something to you about not wanting to